there's one of two things that are happening when a high is broken. Either it is a breakout and the trend will continue. And if the trend will continue, then the dollar should also be continuing its trend. But how do I know whether it's a breakout or whether it's a run on stops? And I should actually be paying attention to a potential sell. Hey, so this video, we're going to be going into a deep dive on how I use intermarket analysis to really be confident in what I'm expecting in the markets, and you can take that and use it as well. So a really value-packed video. If you receive value from our channel and you want to see more videos like this, please remember to press the like button, share it with some people, and comment any feedback that you have. All right, so let's get into it. But intermarket analysis is when I compare different types of assets to each other so that I can get a more confident bias on what it is that I trade, right? So different types of markets, and I'll just give an example, right? I don't trade DXY, but I look at the dollar index, right? And the dollar index is inverse to XXX USD currencies and correlates with USD XXX currencies. All right, so if I'm expecting bullishness in the dollar, then I'm expecting bearishness in XXX USD. If I'm expecting bullishness in the dollar, I'm expecting bullishness in USD CAD, USD CAD or USD Chef. All right, so in dollar index is one of the things that I'm going to look at, and I'm going to compare that to the currency that I'm trading. So I'm comparing the currency pair to the actual currency that I'm trading. All right, now outside of the dollar index, I'm also going to look at treasury bonds, right? Treasury bond prices. Okay, and I'm still getting better at explaining the ins and outs behind it, but the main thing is that at the end of the day, treasury bonds go opposite to the dollar index, right? So when treasury bond prices are traveling higher, dollar index is typically going to travel lower. And when treasury bonds are traveling lower, dollar is typically going to trend higher, right? And I'll show you the charts for the treasury bonds in a second. But the main thing is that truly what happens is that when treasury bond prices go up, the yield on treasury bonds and the interest rate goes lower, and the interest rate goes in correlation with the dollar. So that's the reason that, just keep it simple. All right, when treasury bond prices go up equals DXY down. All right, and then I will look at commodities, and I look at one commodity for all. I look at gold. Right, I look at gold, right, because gold should go the opposite of the dollar. All right, so the way that all of this comes together is that, and then of course you have your currencies, which I talked about right here. So the idea is that if I'm trading Euro USD, okay, and I'm expecting this on Euro USD. All right, you know what? We're going to actually do the path today. All right, and I'm expecting this on Euro USD. All right, then I'm going to want to confirm that. All right, so if I'm expecting buys on Euro USD, I'm going to compare it to a dollar first. All right, so boom. All right, DXY. And so if I'm expecting Euro USD to do this, then that means that I should be able to see DXY doing this. All right. Now, if this has already been happening, and so what I expect next on Euro USD is I would expect Euro USD to do this, to come down, create a higher low, and then continue higher. So that means when I go compare it to the dollar, that means that the dollar should be, hey, stop it. That means that the dollar should be doing this. All right. So I'm going to compare the two. All right. Now, in alignment with this, if I come look at the dollar and I'm expecting this on Euro USD, but let's say that I look at the dollar and what I actually see on the dollar is not that. I actually see the dollar doing, the dollar should create lower highs, right? That's what I should expect, lower highs. And then Euro USD would be creating higher lows. But let's say that the dollar is actually doing this. All right, something like that, right? But the idea being, let's say that the dollar had recently just created a higher high, right? So I see a higher high on the dollar, and then I'm seeing a higher low on Euro USD. That means that the dollar is now beginning to trend up, and Euro USD is beginning to is still trending up. All right, this type of situation, it makes me start to doubt, and not doubt, but anticipate, right, a potential reversal. Because as institutional traders, there's one of two things that are happening when a high is broken. Either it is a breakout and the trend will continue. And if the trend will continue, then the dollar should also be continuing its trend. But how do I know whether it's a breakout or whether it's a run on stops? And I should actually be paying attention to a potential sell. If you're a professional or an entrepreneur focused on making trading a reliable stream of income, whether you're working in your job full time or you're focused on running your business or both, and you just need a few more answers, click the link in our description for access to our free market prep mini course. All right, we're constantly updating this mini course with free value that we wish we would have had when we started. Whether you're a complete beginner or you're on your journey and just looking to get funded, I've been trading for 5 years now, profitable for over 2 years, funded with over $100,000 in prop firms. I know what it's like. All right. I've been there, done that, failed in so many different ways. And so we're constantly updating that with value. Make sure you click that link below and don't forget to like and subscribe to the video. Let's get back to it. Actually be paying attention to a potential sell opportunity on Euro USD. Well, when this happens, that's exactly what I'm able to expect, right? I'm able to be a little bit more cautious in the potential that this break of a high on Euro USD may not actually be a break of a high, because there's now a what they call divergence, right, between the dollar and between Euro USD. Okay. Now, there's a lot of people who trade divergence theory, but again, just like with everything when it comes to institutional concepts, the idea is that you're paying attention to the divergences happening at specific levels. So, for example, how I just pointed out with GBP USD, we just recently swept July's lows, and dollar also just recently swept July's highs, right? So as Euro USD is breaking through a higher low, that's especially going to be a time when I'm going to do intermarket analysis to figure out whether or not I should continue to have faith in the trend, or should I be paying attention to whether or not an opposite type of action is going to happen. Now, right, the idea is like this. I might doubt the dollar, right? I might doubt the dollar. So how do I check to see if the dollar is to be trusted, right? How do I not know that the dollar is actually about to reverse after coming above this high, right? And so I don't need to trust this right? Because maybe the dollar was just sweeping these highs, and now the dollar is actually going to continue lower, which would mean that I should keep my trust in Euro USD, and Euro USD is actually going to go astronomically higher, right? How do I know that? Well, now I'm gonna move. Oh man, I wish it would let me scroll a little more. All right, I'm going to take my attention off of Euro USD, and I'm going to now compare the dollar. All right, so if I see the dollar is now making higher highs, higher low, higher high, then that means that what's next? So I use the dollar in reference, and that's why I mainly trade majors, right? I just keep it simple. I mean, I have a likeness sometimes to GBP JPY, but at the end of the day, I mean, you just gotta stick with what works, all right? There's no reason for me, like, until I'm withdrawing $1 million from the charts, I'm not about to sit here and try to make it fancy. The majors work at the end of the day. So I trade the majors, and when it comes to the majors, they are coupled to the US dollar, and the US dollar is the strong currency, right? Maybe if I traded GBP JPY, for example, right? Well, now there's no dollar in this pair, right? But at the end of the day, the side note that I will throw in on this tangent is that typically these types of pairs that don't include the dollar, except JPY, like JPYs are very strong regardless, it tends to be. But in general, cross pairs, they tend to be stronger when the dollar is consolidating. Right? So say the dollar is in a consolidation for a day or a week or whatever, that's when you'll typically see these be able to do what they need to do and trend a lot better, right? So that's something to take into consideration. Now, there is a certain correlation that these would have with the dollar, but in this type of situation, I would probably be looking maybe more so at like USD JPY. And if I see USD JPY is stronger, is moving higher, then that means that the yen is losing strength, right? So I would probably then pay attention to the yen losing strength would give GBP some bullishness, as long as the pound is either staying the same or getting stronger, right? So there's different ways that I would go into it, but of course it then comes down to what you're trading, all right? So that was a little tangent. But the main point being here, now, if I'm not sure about what the dollar has going on, and this is the reason you'll see me go from 1 to 2 to 3, right? I start with the dollar, and then just to make sure that the dollar can be trusted, I'm then going to go look at what I can compare to the dollar, which is treasury bonds, all right? T-bonds, all right? Now, these are supposed to be going the opposite direction of the dollar. So if the dollar is showing that, hey, I just created higher highs, right? We took Euro USD out of the picture for right now. But if dollar is creating higher highs, then that means that T-bonds should be creating lower lows, because they should go opposite of each other, right? And let me star this. Why is that not on my favorites? All right, so T-bonds should be going like this. All right, so if I go check treasury bonds, and treasury bonds have just recently created lower lows like this, and I'm comparing that to the dollar, then I'm going to take dollar at its word that it is actually reversing from this downtrend and going higher. And let me actually form a reversal here on T-bonds. So yeah, so let's say T-bonds was going higher, but then boom, we get a lower lows now on T-bonds. Now, if this is happening, then I'm going to be seeing, okay, no, dollar is actually looking to go higher. T-bonds is going lower. So that validates furthermore that I may be looking for what we call turtle soup. And that will have to be an entire different lesson. But I'm looking for a run on stops on Euro USD. So even though I would expect Euro USD to continue higher, given that dollar is now going higher and T-bonds is going lower, that confirms the dollar, and that confirms that this is just a run on buy stops. So going into this week, I would then pay attention to Euro USD forming some sort of a lower low. As soon as I see that break of structure, then I'm now going to be confident to take my sells on Euro USD, right? And then one more that I compare to the dollar always, and that's why you'll see me look at gold even if I don't trade it, right, is a commodity, right? Commodities tend to go the opposite of the dollar, because if nations are interested, if the dollar is higher in value, then economies are going to be less interested in investing in commodities such as agriculture or metals, right? They're going to be more willing to hold their dollar because the dollar is going up in value, right? But if we see that the dollar is going down in value, then that's typically when people will you'll see people putting their money in assets that can actually utilize it, right? And so, boom, I would then expect commodities to be doing the same thing, right? Commodities, maybe it was trending higher, but if dollar is creating higher highs, then I would expect commodities to be forming lower lows now, and that would confirm the dollar. Now, what happens when I go to check the commodities or I go to check T-bonds, right? And I actually see that no, T-bonds is also still going higher. Right? So that means I have Euro USD going higher, I have dollar going higher, and I have gold going higher, right? That means that the liar here is dollar, right? And what's actually happening is that dollar is sweeping buy side liquidity. And so I would then anticipate, right, lower prices on dollar. Okay. Now, and for a bonus, T-bonds tend to go the same direction as indices. So maybe if this whole example was about indices, then of course you would expect indices to go the opposite of the dollar, but you would expect it to go the same as the bonds, and that's the case, right? But at the end of the day, that is the reason that I do intermarket analysis. I typically would do it before every session, but especially at the beginning of the week when I do Market Outlook. So when you guys get on Market Outlook and you see me going through charts that I'm not going to take a trade in, it's like you're not like, well, what the hell are we looking at this for, right? You understand that before I even take my eye to Euro USD, it's very easy to spot structure. But first I need narrative, right? And this is why I said, like, we're not price action traders. We're not market structure traders. We are trading the narrative of what's going on. All right. So the first thing I'm going to go do is I'm going to go look at the narrative, right? What is dollar doing? Okay, dollar's creating higher highs, higher lows, higher highs, higher lows. Well, that means that gold should be giving lower lows, lower highs. T-bond should be giving lower lows, lower highs. So that if I go check those and that's not happening, then I'm expecting a reversal on the dollar from the rip. So now when I do go look at Euro USD or I do go look at USD CAD, I'm already knowing that the liar between the two ain't going to be the currency. It's going to be the index. It's going to be DXY, right? So that is how those come into play and why those are important. So what we're going to do is let's, for one, give what the actual T-bonds charts look like. You guys can take those. All right, so when it comes to the bonds market, I got them in my column because I be contemplating who lying. All right, but when it comes to the T-bonds market, I want them back up here. All right, you have ZB. This is the code for them, the currency code or the asset code, whatever. Reset. All right, this is the T-bonds chart. All right, so ZB1 exclamation mark is the 30-year Treasury notes. Right, ZN1 is the 10-year Treasury notes, and ZF1 is the 5-year Treasury notes. All right, what does that freaking mean? I mean, that's what I said. All right, I typically just look at ZB1, but the interesting thing is you can actually compare these to each other to figure out if there's a divergence between them, because they should all be going the same direction, right? But like I said, ZB1 is the 30-year note. Right? Some of y'all watching this video, you just want the sauce. You don't want to know why it works, and that's cool, right? I want to trade hedge fund. I want to trade institutional money one day. Like I want Saudi Arabia to hit me up and say, yo, we want you to trade our money for us. So I like to know all this stuff so I could be a professional in the markets. So for those of y'all that care, this is that, right? So ZB1 exclamation mark is 30-year notes. ZN1 exclamation mark is 10 years. ZF1 is 5 years. Now they typically should really all be doing the same thing. But just keep in mind that this is the long-term notes. This is intermediate notes, and this is short-term notes. Why does that matter? Well, the idea is that when it comes to a bond, right, the way that a bond works is that when you get a bond, you get them in notes, and they expire after a certain amount of time, right? So you'll get when it comes to currency bonds, for example, they are in 5-year notes, 10-year notes, and 30-year notes. All right. So anyone who's in positions for, ZF1, oh, that's what I'm missing is the one, right? For ZF1 notes. Right, they are in a 5-year contract. So these are more short term. They're more likely to change short term. Right, these are 10-year notes. Anyone who's in on this asset is going to be holding those for 10 years. And the ZB1 is 30-year notes. So anybody who's in those is going to be holding them for 30 years. Hence why they are long-term notes. All right, now all of these should be trending the same as you see, right? Amongst all these charts, they should be going the same direction. All right, but again, I can every once in a while, I can check my chart, and if I see a divergence between these, then I know that, okay, what's happening here is not actually happening. You feel me? But for the most part, as you see, they're going to be going the same direction. All right, so that's the treasury notes, and that is how we do our intermarket analysis. All right. Oh, and lastly, the third thing that I'll compare, I'll do DXY, I'll do bonds, and you'll also see me look at Euro GBP, right? Because I trade Euro USD and GBP USD. And again, if I know dollar is going higher, that means that Euro USD should be going lower, for example. But that means GBP USD should be going lower too. So like, which one do I trade? And do I trade both? Too much work for me to trade both. I'm gonna just be honest with you. Like, it was cool when I was like younger in my trading career, but like, I just want to get my money and go, right? So I look at Euro GBP, and the idea with Euro GBP is that if Euro GBP is going higher, then that means that Euro is stronger than GBP, and GBP weaker, which should be self-explanatory, right, than Euro. If it's trending lower, then that means the opposite, right? That means that Euro is weaker than GBP and GBP is stronger than Euro. Well, why does this matter? Well, if the dollar is going higher like it is right now, then I would like to take sells on Euro or on GBP. Okay, so if I want to decide which one I want to sell the one that's the weaker of the two. So if I'm looking for sells on Euro or GBP, I'm going to look at Euro GBP and I'm going to sell the one that is weaker. So if Euro GBP is going higher, then I'm going to probably be paying attention to GBP for the week for my sells. If Euro GBP is going lower, then I'll probably be looking at Euro for the week for my sells. Hence why you saw me selling Euro USD this week. As you can see on this chart, this entire week, Euro has been selling. Euro GBP has been going bearish. So I would prefer to sell Euro USD over GBP USD. If the dollar is bullish, if I expect bearishness in the dollar, then I'm going to want to trade the one that is the stronger of the two because I'm expecting to buy Euro or pound. So I'm going to want to put my money in the stronger currency. That's where I'm going to want to park my money. So if Euro GBP is going higher and dollar is selling, I'm going to want to buy Euro. If it's going lower, I'm going to want to buy pound, right? So that's the reason you'll see me look at these. And by the time I finished looking at dollar, I finished looking at the bonds market, and I finished looking at Euro GBP, by the time I actually get to a Euro USD or GBP USD chart, I mean, it's just higher time frame analysis and then finding my key levels, and I can sit back. I mean, it's pretty self-explanatory from there, right? And while I'm trading on the day, I do tend to pay more attention to Euro GBP as I'm trading, because it'll kind of give me an idea as to whether or not my trade is panning out the way I want it to, right? Again, if I'm looking to sell if I'm expecting to sell Euro USD and I notice Euro GBP is seeing more bullishness than I expect, like right here, that would have been a little bit annoying to trade. I was out of the market by Thursday, but that would have been a little bit annoying to trade. It's not to say it won't sell. It's just that it's going to give you a lot more difficulty than the other one, right? Because it's clearly getting stronger, right? If the euro is going up and the dollar is going up, and you're trying to sell it, yeah, it's going to go down because dollar's so strong, but it's going to be a little bit choppier. Your stop loss might get hit. Your entry might get hit break even a couple times. And you just have to expect that and deal with that. You feel me? So that's kind of the idea behind those. So that is how we go about doing our higher time frame analysis and starting off our week, and the reason that market outlook goes the way that market outlook goes the way it goes. So now when you guys are watching market outlook, you can have a little bit better of an understanding of the path that I'm taking, and I typically take that same path every week: dollar, bonds, currency or indice that I'm trading. Dollar, bonds, Euro GBP, currency that I'm trading. Like, that's really typically how it goes. And really, when the dollar is ranging, you may see me actually trading indices over it. You feel me? So that is that.
Mistake. Maverick here at 2 a.m. in the morning in the do-rag to make sure that these videos are perfect for you. All right, if you made it to the end of this video, clearly you've gotten some value. So leave us a comment, like the video, and subscribe. We really appreciate if you share the mission, because our goal is to empower entrepreneurs and professionals, whether they're working a career full-time or running a business full-time, to make a reliable income through day trading currencies and indices. Okay, we have a weekly market outlook that releases on this channel. We do it live in our community, so feel free to join our free community so you can get access to stuff like this live. Okay, other than that, we have videos coming out on this channel to go ahead and educate. We have a free mini course in the description that you can get access to right now, and plenty of other value on the way. So you guys have a great one, and see you on the next video here on the Traders Guild.